I think the facts are this is the most activist administration when it comes to business, maybe since FDR. I don't know. I'm a history of I'm a student of U.S. history, but you're stretching me there. But yeah, this is an extraordinarily activist administration. Anyway, so I guess that's one, and maybe the most obvious factor is tariffs, which are at the end of the day a tax, and so somebody's going to pay that tax, and it's either American businesses or it's American consumers. So yeah, that's out there, and then yeah, there's a lot of pressure or attempts to influence these companies. So that's out there too. Look, all of that's part of the backdrop that all of these CEOs and these executives have to deal with. They're paid to deal with these kind of challenges. It's just unusually high, in this administration. The backdrop to the tech sector, however, there's some other things that are well within their control that are really lifting, what's a 3-year bull market now in tech stocks, and that's it's Gen AI and what we're seeing in terms of reduced costs and improved processes and improved products and solutions and offerings. It's really, we're going through a major super cycle here when it comes to Gen AI. I know it's been overhyped at times, but there's a lot of reality behind it, and there's some companies that have had really good stock price performance precisely because they're perceived as Gen AI winners.
That's right. And of course, when you're talking about AI, I have to bring up semiconductor and chip maker stocks. When you think about the juxtaposition between former President Biden's types of policies versus President Trump's call just recently for 100% tariffs on chips coming into the U.S., will all of this make for a more robust, domestically located semiconductor industry? Or is that really possible? Break that down for us.
I'm not sure I've got a really thoughtful, educated answer to that question. You're asking, you're asking whether if you want to promote U.S. manufacturing, particularly in what are considered to be highly strategic industries, whether it's better to use incentives and subsidies. I think that crudely explains the Biden administration policy, or whether it's better to use, tariffs and browbeat companies to come back into the U.S. And I'm not sure. I mean, they're both active government policies into businesses, and so I'm not sure. It is, and it's just an interesting step up. I mean, we had a laissez-faire, economy. Generally, government stays out of the way of business, and we've had a lot of look. I'm out here in tech land. Most of these companies are out here, and they've been very successful, run by entrepreneurs. They come from different parts of the world. They come to California area and other parts of the U.S., and they create these extraordinary businesses, and they've done it on their own. I mean, there's always some help there, but they've pretty much done it on their own, and I think that's actually created a really good situation for people in this country. I hope we don't spoil that.
Well, let's get to some of the numbers that we got this week, and certainly the week before. I caught some of your calls following the updates. Zillow was out this week. You raised your price target on it. Uber, too, you raised your price target on that one to 150. DoorDash, you upped it to 360, the price target. What companies' results show to you kind of a more interesting investment thesis as a result, either this week or last week when we got some of the big major tech names?
Well, I like to set up on a question. So where I thought we had some just really surprisingly constructive, positive results, I thought DoorDash was in that list. We had some record high operating margins out of that company. Meta was definitely in that list. And most of the other names, I thought those are kind of two standout companies. Maybe Booking.com was in that list too. The other names, we had some good prints out of names like Google. We had some good prints out of names like Amazon. But the really strongest, kind of cleanest prints, there were a few in there, and I would put Booking in there, DoorDash, and those would probably be at the top of the list. And if you just step back, because we started off talking about some of these macro concerns, and these companies give you a very broad read into the economy. They do, into consumer demand, into some enterprise demand. And if I'd use one single word to describe the results of this earnings season, it's resilience. It's not like we had a positive inflection, although there are a few cases where that happened. But generally, the overall view is that spend has been relatively resilient, and it's at a relatively robust level for these companies. It's this may change in the back half of the year, but so far so good.
Mark, you're comfortable with Meta in particular. I mean, we had some news today, too, that they have selected Pimco and Blue Owl, Owl Capital to lead a $29 billion financing for their data center expansion in rural Louisiana. It's all about the race for AI infrastructure. We know that. This is, according to people familiar, that major mega spend and the talent grab and what they're spending for AI talent, Meta, you're comfortable with all of it.
Well, I guess if they keep putting up prints, if they keep putting up fundamental results like they are doing, where they're using AI to improve their cost structure, but also to improve their products, like you're getting an ROAI, return on ROI, return on investment, ROAI, return on all that AI CapEx spend and OpEx spend. They took their revenue growth and they reaccelerated it despite being at the scale that they're at, 150 billion roughly revenue run rate. They took their revenue growth and accelerated to 20%. They didn't come out of nowhere. They were using AI to better target ad campaigns, and so marketers are getting a better return on their Meta ad spend, and consumers are finding the service better. I mean, the evidence is that they're spending more time with Meta, they're spending more time with Instagram. There's nothing more objective than just time spent. So Meta's been able to use all that AI investment to improve their product, improve their service, and yeah. So if you keep doing that, you absolutely you earn the right to spend more, to invest more.